Market's doing okay in trade. The stock that reacted badly to its numbers and is seeing a lingering impact this morning is Jubilant FoodWorks. Ajay Kaul joins in to talk about how the next year is shaping up for the company. Ajay, hi, good morning. There was quite a bit of disappointment with that same-store sales growth guidance that you guys put out, and I know in our last interaction you were pretty candid about the fact that same-store sales growth is slipping. Could you just walk us through whether this is a conservative estimate that you've put out and what exactly has led to this much of a decline?
Good morning. You know, we have been saying this for some time. A company which has been doing around 30% kind of same-store growth, for them to come out with these kind of numbers probably may sound a bit disappointing. But, you know, it's all economy. There's nothing more than that. If you were to compare us with comparables within our own industry, which is some of the other big players in the quick service restaurant industry, 7.7% will still look very good. But are we happy about it? Not at all. But the larger story, you know, which I want to kind of dwell on is the growth story. If you see the growth potential in India is something which we are always upbeat about, and we are putting all our money behind that. I want to dwell here on three things. One, we had said we will open 110 stores in the year. We had started at 90 and then taken it up to 110. We actually did 111 stores. And our forecast for next year is 125 stores, at least. That is Domino's alone. And even going forward, we believe we can do at least 125 stores year after year. So that's our belief and trust behind the growth story. Yeah, there is a temporary blip which is driven primarily by macroeconomic factors. We believe, the optimist in us tells us that it is not going to be for long that we will deliver single digit, same-store growth numbers. We do believe we will get into double digit, hopefully in the next, few months. And economy is going to help it primarily and nothing else. Talking about next year, we think we will do at least 10% same-store growth. We think we will deliver at least 16.5% return on EBITDA, as an indicator of profit. And as I said, 125 Domino's stores and at least 18 Dunkin' Donuts stores during the course of next year.
That's exactly the point, Ajay, and that's what, is difficult to marry. The kind of guidance you guys are putting out in terms of same-store sales growth, which is as low as 10%, versus the guidance of opening 125 stores. 50% of those incremental stores, I think, is from the top 10 cities for you guys, where you've talked about cannibalization problems as well. So, how do you marry this disconnect between how low your same-store sales guidance is versus how aggressive you guys are being in terms of fresh store openings, and that's in the top 10 cities? Are you being overly pessimistic?
No, there is no disconnect there. Honestly, while there's a small linkage between opening new stores in existing cities and it tends to cannibalize a little bit, but that has been something as a part and parcel of the industry. It was there last year. It was there even in the years where we have done 37% same-store growth and 30% same-store growth. It has a very small impact. Nonetheless, there is that impact. I think the larger picture emerges from, as I said, the economic factors. Consumers have started downtrading. They have started conserving cash. While we are an absolutely impulse purchase, high discretionary spend, low ticket kind of an item, but surprisingly, while we have been saying this for a year, we could see the trickle effect. But by the time we came to quarter 4, is where we ended up at 7.7% same-store growth. But if you look at the full year, at around 16% same-store growth is still pretty good. Now, as we come out of the woods, we are in May now, and we believe that it will take a few months. The government probably is trying to, throw some economic stimuli at the consumers, which is going to, trigger demand and which is going to kind of bring the consumerism back. But we do believe it may take some time, and that's why I would say 10% is a number, we are kind of confident about. It's not with pessimism, but, we are also a company which believes in delivering more than what we promise. And that's the note where I will end this, my statement of mine. But I want to make one more statement with regards to the growth potential. If you look at last year, while 7.7%, on one side is the same-store growth for last quarter, but during the course of the year, we spent nearly 50 crores of rupees in upgrading what we call our factories, our commissaries. In Mumbai, for example, We moved to a new facility, we spent around 25-26 crores there. In Kolkata, we invested in a new commissary which costed us around 12-15 crores. And we opened a brand new commissary in Chandigarh. That's an experiment we did for around 10 to 12 crores. And inspired by that, during the course of the following year, which is the year we are sitting in right now, we plan to invest around 70-75 crores of rupees in building 4 more commissaries. One around Nagpur, one around Hyderabad, one around Guwahati, and the one in Delhi, which was commissioned around 3-4 years back. We want to move to a state-of-art 3 times the size facility. Now all this is happening because we are looking at the future. We are not getting bogged down by 1 quarter or half a quarter where our same store growth may be 7.7%. The larger picture is that this country, our country, India, offers us to add at least 125 stores year after year. And keeping that in mind, are we investing so much of cash into creating infrastructure? Additionally, last year, if you see, our marketing spends only went up because our philosophy is that when it hits a bit of a downturn or the times are not too kind of conducive, that's the time to put money behind your people brand as well as your brand. That's why last year, if you see, our marketing spends went up. We launched our new positioning, which was Ye Rishton Ka Time. The consumers are already resonating with it. It's a different story that they have decided to kind of conserve a bit of cash and they're not spending as much, but it's a temporary blip. And as importantly, something which is not known to, let's say somebody like you, we have increased our training budgets to almost double because we believe this is the time when you go to tell your employees that times may be a bit tough, but we believe in you guys. We are a people business. We have 22,000 employees all over the country. We want to, be looking at the future and the growth is where we want to invest in you.
So that puts more pressure on your margins, does it not, Ajay? Because you do have increasing staff costs, you have increasing rentals, and inflation is breathing down the necks of most companies like yourselves. What steps are you taking to address these cost pressures, and how long before you can get back to those 18-19% margins that you used to see before?
See, there is a small price, I must admit, one has to pay when one is in such a humongous growth phase. If you look at last 3 years, 87 stores, 111 last year, and the next year we are saying at least 125. And it will continue like that. So when you are in this growth phase, you have to make some investments in business. For example, I did talk about investment in factories, around 50 crores last year, 75 crores this year. Such investments will continue. Investment in creating bench strength, leadership pipelines. Now that's a small price you have to pay in the short run, and I would urge you, our investors, our shareholders to realize that if they look at Jubilant FoodWorks, they are looking at a company which is riding the consumer, call it the growth potential of this country, and they should look at it from long-term perspective. We are making a rock-solid organization for future. In the interim, in the short runs, suddenly if the same-store growth is at 7.7% and all that should not, confuse them at all, because we will get back as soon as the economy revives a bit. Getting back into double digits is no issue. Now coming to the question of, margins will get impacted marginally, we believe. As I said, our guidance is 16.5% EBITDA return on sale compared to, let's say, 17.3 which we will deliver this year. But at an absolute scale, the margins, EBITDA will still go up. So I do believe that as we move in a couple of years' time is where we could start leveraging our fixed costs a bit better, and we will be able to spring back our margins also.
Can you just throw some more light on what the exact rollout expenses are for Dunkin' Donuts and how much time before which that starts to contribute to the business?
See, Dunkin' Donuts, this year, for example, the bygone year, contributed to a small single digit in terms of sales. Its impact on EBITDA was around 70-80 basis points. Now, with the kind of aggressive plan which is there for both Dunkin' and Domino's, but Dunkin' would always play a small brother's role, and Domino's as a result will play the big brother role, because, by the time, let's say, Dunkin' reaches 100 stores in 3 to 4 years' time, Domino's probably would be sitting at 1,000 stores, to put things in perspective. So its impact on the overall performance and the P&L will always be small, but having said that, we are mercilessly focusing on it. The first 10 stores that we have opened in Delhi NCR and one in Chandigarh that we have opened have given us very encouraging results. We plan to open at least 18 stores this year. In that, we also plan to enter at least one more metro. Without naming that metro, we will be definitely entering one more metro. And we are on course to, I would say to open around 80 to 100 stores in 4 to 5 years' time. And needless to say, for Dunkin', we are leveraging the Domino's infrastructure beautifully. From our existing factories of Domino's, we will create Dunkin' factories, so there is a leveraging of infrastructure costs. As far as people is concerned, we have a huge bench strength, call it talent pool sitting in Domino's, which we are constantly using for Dunkin' Donuts. So we are hoping that in the next couple of years, 2 to 3 years, even Dunkin' business on a standalone basis should start showing profits. And after that, the ride is going to be that much more smoother.
Bear with me as I drone on about this same store issue for a little bit more, Ajay. You know that Q4 is traditionally the weakest reporting number for you guys in terms of your same store sales growth. So I'm trying to understand if this 10% guidance that you're setting out is a base for you, or your indication of your weakest possible number through the course of FY14, or is that going to be the average kind of growth that you expect to see?
See, I must be candid about one thing. There has been no year in our history where the drop in same-store growth has been such. Even in the years where we did 37% same-store growth or 30% same-store growth, which was year before last, the dispersion was probably, in the year we did 30, was between 33-34% at the maximum and maybe around 25-27% on the minimum. This has been one year where we started at around 25% in one quarter and it has ended at 7.7. So there has been a huge dispersion. While we could see that at the consumer level, we could see the signals in terms of drop in frequency, or I would say not the growth in frequency was not as much, or in terms of penetration or new customer acquisition, again the growth was not as much. But we never realized that the drop would be so much. And these are, I would say, 90% driven by macroeconomic indicators. You can look around and see how our, immediate competition is doing, and their numbers are also in public domain. A lot of them are in sub-zero range during the same time periods. That is giving us a bit of, I would say, concern that how can the dispersion be so much. Having said that, we also go back to the Lehman Brothers time. In that year also we had around 6 to 7% same-store growth. But the moment we came out of that, in the very first quarter after that, we clocked something like 22% same-store growth. So the optimist in us is telling us that, a few stimuli thrown in by the government, by the economy, for a 300-350 purchase outlay, consumers are not going to hold back or hang on for that long. They are going to swing back according to us. And the day is not far, and we are hoping that the numbers will climb back into double digits. Now, why we may be sounding, a bit conservative, if you use the word at 10%, is this, the significant drop has also, taken us by surprise, because we have never seen this before. So we don't know how long this will continue. The optimist in us tells us that it should not continue for that long. We are also obviously, throwing a lot of interventions, marketing and advertising interventions into the market. What I would say, promotions for our customers, new product launches, and so on and so forth. So we hope to turn the tide, sooner than later, but we don't know, is what I would say. That's why we are banking more on our future growth, which is build 125 Domino's stores, build at least 18 more Dunkin' Donuts stores, put money behind product launches, advertising, put money behind, your factories and commissaries and so on, create infrastructure for future, put money behind people, and as soon as you're coming out of the woods, you are hitting the road running, while your opposition may be still kind of trying to figure out what to do.
Your guidance is conservative, but your body language is not, Ajay. Just one final question from me in terms of...
I should maybe hold myself back now like this. So let me change the question
better than I.
for your benefit.
You know better than I, Ajay, that for
Kidding, don't
most
worry.
businesses, for most businesses, growth in volume tends to overlay any other concerns, whether it's margins or anything else. Over the course of the next few years, for you guys, what would you say is the biggest challenge? Is it to bring volume growth back, or do you think the pressure is more towards the lower end in terms of maintaining profitability and ensuring that margins are not damaged anymore?
See, honestly, if I have to kind of, put my money where my mouth is, or probably try to assign weightages to, clearly, if you look at penetration, if you look at per capita consumption of pizza and so on and so forth, there is still so much work to do in terms of bringing more and more people into this, call it, group of people who understand what quick service restaurants are, what pizza are, and so on. And we look at country as a whole here. So, challenge number one is get more and more people to taste, eat, consume, and understand what QSR and pizza are. Then increase their frequency. We are not as much bogged down about margins. Margins we have to protect. We are after all a public limited company, and all our shareholders we are accountable for. We will never let them down. But clearly, for the next 4 or 5 years, growth is where we are focusing on. Whether it's in terms of new stores, whether it's in terms of entering new cities, whether it's in terms of bringing in new brands, and whether it's in terms of same-store growth, which temporarily may seem not too optimistic, but we are pretty much optimistic that we will get back into the numbers we have been somehow delivering in the past. And the margins will come, trust me. The margins is something which will follow, as soon as the same-store growth climb a little bit. But growth is what we are focusing on, which in terms then means orders. It means more consumers, more penetration, more frequency, and so on.
As always, we wish you luck, Ajay. Thank you very much for joining in. That's the Jubilant FoodWorks management talking about where growth may be headed. Conservative guidance, of course, but they expect things to recover at least 10% same-store sales growth. Let's take a break on that note. The market is holding pretty steady today, actually. No big ruptures or ripples in trade. We'll take a break, come back, and get talking to some more corporates.